Okay. Well, welcome everyone. Thank you so much for joining us this afternoon. I think you're in for a great hour. We have as our guest today on this overview of the 2020 election legislative outlook, Ken Kies, who's managing director of the Federal Policy Group. Ken is just a well-known person in Washington, and I'm going to read his bio here in just a second. But first, we want to welcome you to this presentation on behalf of Haran, and thank you very much for your business and confidence. We appreciate it, and this is one way we can say thank you. In the past, we've been able to have these in person, and today is our first tax policy seminar that we've done virtually. But anyway, Ken is the managing director of the Federal Policy Group, and the Federal Policy Group provides sophisticated, strategic, and technical tax advice on tax matters that come in front of the U.S. Congress, the Internal Revenue Service, the Department of the Treasury, and other organizations. Ken spent a fair amount of time of his career as Ken, you may have to help me. You were on Ways and Means for a number of years, were you not?
I was the chief Republican tax counsel on Ways and Means from 81 to 87.
And then again, you were involved in significant pieces of tax legislation at that point.
Well, that was the 81 Act, the 82 Act, the 84 Act, the 83 Social Security Act amendments, and the 86 Tax Reform Act, and the Surface Transportation Act of 83, just to name a few.
Yeah, it kept you busy. And another interesting fact about Ken is he is as his LLM from the University of Georgetown. He graduated from Ohio University, and I think been honored there many different times for many different reasons at Ohio University. And he has run 6 marathons, including Boston. So Ken, if nothing else, you're in my awe for that. That's a terrific accomplishment. Ken and I have known each other for a long time, and I think we're in for a great afternoon hearing about Ken's thoughts on the election and the legislative outlook. But first, Ken, before you get started, since it's so topical, can you tell us a little bit about where we are with the stimulus plan number 4 or 6 or whatever number?
No, it's number 4. So the answer is we're not in a great place, and I can make this very brief. The reporting in the so-called mainstream media this week has been that they're getting close. Mnuchin and Pelosi are talking. But I direct your attention to today's Wall Street Journal article, which I believe it's on A4, and the final paragraph. After the whole article goes through of they're meeting, Meadows isn't in the room. That's good because Meadows is a bad guy. The final paragraph is, but they're still far apart on 2 issues, aid to state and local government and the liability shield. To which I say, duh, that's where they've been for 4 months. And the problem is, when these kind of situations arise, the mainstream thought in Washington is they're going to get a deal, they're going to get a deal, they're going to get a deal. But sometimes you have to look closely at where the 2 sides are and say, can the 2 sides actually find a place in the middle that they can sell to their side? And in the case of Pelosi, if she goes too low on the total, her side's going to erupt. If in the case of McConnell, if he goes too high, which is probably anything over $1 trillion, his side's going to erupt. And if he doesn't get the liability shield language he wants, he's going to have to say no because he's got a line in the sand on that that's been there for 4 months. And there's no sign Democrats likely to agree to the liability shield that McConnell's going to want because of how close they are to the trial lawyers and organized labor. And then there are a couple pieces of economic data that are relevant to this discussion because it explains why Senate Republicans are not so nervous about getting another deal before the election. Point number 1, September 4th, the job numbers came out for August. The unemployment rate was 8.4%. The economists, who, by the way, have been wrong all year on almost every number they've predicted, had predicted 9.8. Just to put 8.4% in perspective, the first 3 years of the Obama administration, the unemployment rate was only below 8.4% 2 months. January and February of '09, which makes it the 8.4% in August unbelievable. We're in the middle of a pandemic, and we've got a better employment situation than Obama had the first 3 years in office. That's something we know. Tomorrow, we're going to learn what the job numbers are for September. Based on reports yesterday, it could be an increase in jobs of 750,000, which would be viewed as pretty good, not hitting it out of the park, but not terrible. And then point number 3, we know that in the middle of October, we're going to get the GDP growth rate for the third quarter of this year, which ended yesterday. Most economists, and I say with that with an asterisk that they've been wrong, but most economists believe the annualized GDP growth rate for the third quarter is going to come in at 20 to 30%, which will be the highest GDP growth for a single quarter in history. And it's those statistics that make the Senate Republicans not so nervous about not getting another COVID deal, notwithstanding what's happening in the airlines, where there are tens of thousands of people being laid off. And just yesterday, the day before, Disney, 23,000. But they all, I was on Zoom calls this week with Senator Gardner, Senator Collins, and also in a conversation with Senator Todd Young. They all believe that we may not get a deal before the election, but we'll almost certainly have one in lame duck no matter who wins. So it isn't as though if it doesn't get done now, it doesn't get done this year. And the reason I'm convinced it'll get done in lame duck no matter who wins the election is by the time we get to November, the small business bankruptcies across this country are going to be blowing people's mind. And so I don't think it's going to happen before the election, or I think it's a low probability. Todd Young yesterday said 33%. Gardner said not going to happen. Collins said she thought it would, but she's an optimist. But I think after the election, very plausible. Before the election, I think they're almost out of time. Sorry for the long-winded answer, but there you are.
Great. Thank you. It's very appreciative. And I didn't realize the economic numbers were quite as favorable as you've laid them out. It's great. All right. So would you like to begin on this program that you put together here?
Okay, sure, Terry. So, and again, thanks for having me. I obviously have to start by saying something about the debates, scrum, train wreck, whatever you want to call it. And the internet, as everybody knows, is on fire over this. And there's so much good material, you just don't know where to start. But I'll just pick 2 that I thought were pretty darn good. Alert, there's been a serious malfunction in the broadcast of the debates. The audio has failed, and it is switched over to a nursing home where 2 old men are squabbling with one another. That one was pretty good. But then actor James Woods, who is a conservative, he came out yesterday and said President Trump crushed his opponent, Chris Wallace, head to head in last night's debate. There was another fellow wandering around muttering to himself. Okay. Well, there you are. All right, Chris, let's go to the first page. So, Chris, go to the first page. There we are. All right, that's the second page. Go back to the, oh, no, that is, yeah, there we go. You got it. Okay. All right, so I'm going to give you a quick summary of what we're going to cover, and then we're going to fire through it. So, first point is the tax policy in 2021 will be controlled by the outcome of the election, so we'll renew the possible election scenarios and what each of the 3 of them mean for possible legislation. Then second, we'll look at what we could expect if there are taxes from a Biden administration. Third, what we could expect if we have a second Trump term. I'm going to talk about tax risks for the life insurance industry. And then I'm going to sort of give you a history lesson on looking at the last 5 first-term presidents. What is the pattern of when they pass major legislation in their term in office? And spoiler alert, it's generally by the August recess of the first year. Then we're going to talk about the Electoral College, which I can't remember the last time I actually had a discussion about this in connection with elections, but given things are so weird, there's a lot of serious discussion that this might not get decided by the Electoral College. It might be thrown to the House of Representatives, and I'll explain how that works. And then just if you're not depressed enough, I'm going to talk about how we're doing on the debt and deficits. And then I'm going to talk about the wild cards that could impact what happens between now and election day and thereafter. So Chris, let's go to the next page. And then the one after that. Okay, so I see three scenarios in terms of how the elections could turn out. Scenario one is Biden wins, Democrats retain the House, Democrats take the Senate. Under that scenario, the next section of my discussion will be very relevant because it will discuss how detailed the Biden tax plan is. And in my own view, just flashing forward, I think there's a high probability what I will describe there is likely to be enacted by August of 2021. All right, scenario two, Biden wins, Democrats retain the House, Republicans retain the Senate. Under those circumstances, what I'm going to tell you about Biden's tax plan, I think very little of it gets enacted because I think it gets stopped in the Senate. So we're going to talk about what Biden would do if he has all three, because frankly, if Biden wins, he's likely to take the Senate and keep the House. But it is possible, it would be surprising, I have to say, that if Biden won and Republicans at the same time retain the Senate. Scenario three is Trump wins, Democrats retain the House, Republicans retain the Senate. What that basically means is we're in for 4 more years of gridlock. So I will quickly run through the section of the program on what's in a Trump second term tax agenda, because frankly, I don't think it's terribly irrelevant because I think it's that unlikely Democrats will retain the House. All right, before we go to the next section, let me just offer up a warning. This section could cause nausea, shortness of breath, uncontrollable shrieking, and the pain of psoriasis. So I just want to warn you. And if there are any young children, if this is being done virtual, which I guess it is, if there are any young children in the room who have been counting on an inheritance from you, your spouse, they're going to be terribly disappointed. So you might want to ask them to leave the room. So let's turn to the what we could expect in a Biden administration on taxes. And let me explain the color coding of my presentation. So at one point I was with Baker and Hostetler, a law firm that's headquartered in Cleveland. It's got an office in Cincinnati. And actually, I was with them twice, out of law school and then in Washington. And when I was in Washington, we had a year that went by where we had bomb threats phoned in to the building, like every couple weeks. And the police developed a coding system that if they called up and said, we got a bomb threat, and it's a code red. That basically meant, you know, we got a bomb threat. We're not sure it's real. We just wanted to let you know. We kind of have to let you know because the building blows up and you're dead. We'll get blamed, but we don't really think it's that serious. Okay, that's code red. They call them and say, we got a bomb threat. It's code blue. Code blue is get your ass out of the building right now or we're sending the police dogs in after you. Now, let me just explain what happened when we would leave the building. We'd go out and stand on the sidewalk beside a 10-story glass building. If a bomb did go off, we would have all been buried in glass up to our necks, okay? But there we stood. As it turned out, the bomb threat was coming from a garage attendant who was trying to go home early, but it took a year to find that out. So that explains our coding system. So let's go to the next page. And we're going to look at what Biden has on the individual side. And I have to say, the Biden campaign has been very transparent and specific about what their tax proposals are more so than I can recall in any presidential campaign in the past. I mean, they've laid it all out there. So first code blue is massive individual rate increases. And I'll come back to that in a moment when I talk about how high the marginal tax rate could go under an Obama plan. In terms of other sort of not code blue, but code red items, look at the bottom two items here. The value of itemized deductions would be capped at the 28% rate bracket, even though the top rate would be up in the 40s. And what does that mean? Under current law, if you're in the 40% rate bracket and you have a $10,000 deduction, it saves you $4,000. What this would do is cap your tax savings at $2,800. And this is an idea that's been around since the second year of the Obama administration. And for those of you that are in the healthcare arena, it would also cap the value of employer-provided health benefits, which are currently excluded from income at these same rates. So this is a big deal. The bottom item, the pass-through deduction, which is Section 199 Cap A, it's a deduction that allows pass-through businesses to deduct 20% off their taxable income. 19 million taxpayers currently benefit from this provision, including many small businesses. So repealing this would be a big deal for a lot of people. Okay, let's go to the next page. All right, another code red, not a code blue, code red. 401k plans, same kind of idea. They would cap the exclusion at a 26% rate. The second item down, this is a major code blue. Under current law, the Social Security income tax base, which is subject to a 12.4% tax, 6.2 employer, 6.2 employee, only applies to the first 137,700 of income. Under the Biden plan, it would be applied to not only the first 137,700 of income, it would apply to all income over 400,000. This is an idea that's been around on the Democratic side for years. They've never had the ability to actually pass it. But if Biden wins, a major theme is going to be income inequality. And our Social Security system is going to hit the wall probably in 2032 when we have less incoming tax revenues than outgoing benefits. And the pandemic and the economic turmoil now will probably make that even worse. So this one is very radical, and it'll enter into my discussion of where marginal rates would go. All right, earned income tax credit, Biden would increase it. Energy efficiency credit, probably not a big deal here, so let's move on to the next slide. Another code blue, capital gains tax would go from the current top rate of 23.8 to a rate that's applied to ordinary income, and it would be 43.4 and would also include taxes on dividends. Now, what I'm about to tell you is not investment advice. I disclaim any responsibility for sharing the view that I'm about to provide, but let me just lay out a scenario for you and give you some food for thought. Biden at some point in November is declared the winner. Let's say it's November 10th. Some genius will be quoted in the Wall Street Journal, because geniuses love to read themselves being quoted in the Wall Street Journal. And he'll say the following: you know, if you got any unrealized gains that are subject to capital gains, you better sell right now, because come January 1st, Biden's going to raise the capital gains rate to 43.4. So what will happen? The market will go into a dive like you have never seen before. People will be selling like crazy. So what will the Biden people do? The obvious, they haven't said this. This is me just kind of looking forward. That's part of what I get paid for. But what they will do is they will look up and they will go, we have to stop the market slide. Just having the circuit breakers in the market isn't going to be enough, because it's going to go down day after day. The solution to this is obvious, which is we will announce immediately that any increase in the capital gains rate will be retroactive as of today. So again, you can't rely on this advice. If you claim you relied on it, I'll deny I said it. And I'll say Terry said it. Okay. So Terry made me say it. Okay. But I'm just laying out that it seems almost inevitable that we're going to see something like this. Okay. Let's move on to the next slide. Any of you that happen to be in the real estate business, the whole like-kind exchange, those are gone. They were gone even before Trump's tax return information came out. I got all kinds of phone calls on Sunday when the New York Times story broke. And basically, it was, I got emails from other tax lawyers on Sunday, and they all said basically the same thing. Well, of course he didn't pay any income tax. He's in the real estate business. Where's the shock? Monday, Tuesday, I got all kinds of calls from reporters because if you read the New York Times article, and you must have had a lot of time on your hands if you did, because it was long, buried in there was a part about a refund claim went to the Joint Committee on Taxation, which I was chief of staff of from January 95 to January 98. And the Joint Committee approves any large refund, as in over 2 million. And in this particular case, it was a $72 million refund. So I got all kinds of questions about how does the Joint Committee work, et cetera, et cetera. But even before the New York Times story, like-kind exchanges were not going to make it. Okay, let's go to the next page. And this is a major code blue. Under current law, as I'm sure you probably know, if you die and you leave assets to your heirs, the basis in those assets for determining gain upon subsequent sale is raised from what was your basis to fair market value on the date of death. The Biden proposal would eliminate the step up in basis that I have just described. And therefore, when that asset was sold, the gain would be the gain which would have occurred if you had sold the asset. When we combine that with another item which we're about to share, which is the increase in the estate tax rates, we're talking about effective tax rates on inherited assets in the 60, 70% range, which is dramatically higher than we have under current law. So this is a major change. And as a result, I think there was an article in today's Wall Street Journal saying people, because of what's coming, should consider making all the gifts that they can under the exclusion for a couple from estate and gift tax of what is roughly 23 million now. And those articles will come after if Biden wins, along with the article about sell everything you got and take the gain now. Okay, let's move on to a couple of scary items. They haven't happened yet, but trust me when I tell you they'll be on the table. There is a lot of murmur about whether a wealth tax would be included. Senator Warren loves this idea. The French have it. That should actually tell us enough, all we need to know right there. I don't think it's any more discussion is necessary. But suffice it to say, an annual wealth tax, if it's applied to all assets, would make appraisers the happiest people in the world. But it would be a regulatory nightmare for the IRS to handle. But if you just wanted to make it simple, you apply it only to publicly traded stock. Now, obviously, you would see a lot of people sell their publicly traded stock and buy non-publicly traded assets. This idea has been kicking around out there. And again, if it's a big income inequality push, very possible. Next one is sort of, in a way, similar. It requires taxpayers to what's referred to as mark to market annually the value of their assets. So let me just give you a simple example. On January 1, I have an asset that's worth $1,000. At the end of the year, it's worth $3,000. I would have to include in income the difference, $2,000, even though I haven't sold the asset, and therefore I don't even have the cash to pay the tax. Canada tried this for a while, right behind the French in countries admired for their tax brilliance. And they basically repealed it within a short period of time. But it's getting a lot of attention. And again, if you applied it to non-publicly traded assets, you'll have taxpayers in the IRS arguing for years about what their assets were really worth at year end. Again, it's something that is getting discussion, but I want to be clear. It's not currently in any Biden tax plan that I've seen. Okay. Let's move on. A couple other good ones here. A surtax on millionaires, something that's gotten some attention, but go to the bottom because it's another code blue. Increase in the estate tax rate would be taken up to 40%. I think it goes higher. The exclusion amount, again, which is around 23 million per couple, I think goes much, much lower. Who knows how low. The Biden tax plan doesn't explicitly address this, but within liberal Democrat circles, which is pretty much the whole circle, it's clearly something that's high on their agenda. All right, let's go on to the corporate side, and I can run through this quickly because Biden doesn't really have a lot. The corporate rate would go back up. It's 21% now, and it would go up to 28%. Some people might say, well, corporations got a really good deal in the 2017 Act anyway. It's interesting to go look at the revenue table from the 2017 Act. Corporate tax increases basically completely offset corporate tax losses. So in other words, it was basically revenue neutral in the 10-year period. Now, the drop in the top rate from 35, which is what it was before the 2017 Act, to 21 lost a bunch of revenue. But then there were a lot of provisions that took away corporate tax benefits and a thing called repatriation that required corporations to be deemed to have brought home all their foreign income that they had not previously paid tax on, which raised hundreds of billions of dollars. So the tax base was broadened, but the rate was brought down. So if the only thing you do is come in and just raise the rate back up, then the burden, the effective tax rate on corporations is going to be a lot higher than it was even before the 2017 Act. But right now, not too many people talk about that or seem to even care about it. And it's pretty much accepted. The rate's going up and it's going to go to 28, and some people think it may go higher. The second item down, it's a code blue for corporations, but we used to have an alternative minimum tax on corporations. But the alternative minimum tax on corporations, the way it was calculated is you started with taxable income, and then you added back certain preferences, and then you applied a rate. And if that rate produced more tax than your regular corporate tax, you had to pay the higher rate. That's not what this is. This is a 15% tax on book profits. So that's what you report for financial accounting purposes. Very different from the way the corporate alternative minimum tax works. And it's kind of scary to people who work in the corporate world. That last thing is kind of a sleeper. It's sort of a tax on financial transactions. It's suggested would only apply to institutions over 50 billion. It would maybe only be 7 basis points on covered liabilities. Looks innocuous. The problem with a provision like that, if you enact it, it will only go in one direction. It'll apply to institutions that are smaller, and the number of basis points covered will be higher. And all you have to do is look at the value-added tax in Europe, enacted 40, 50 years ago, started at a low rate with a narrow base, and was supposed to balance their budgets. And Doug Holtz-Eakin, who's a very fine economist, has done a study of this over a period of 30, 40 years, and it never balanced the budgets. Spending went up faster than the increase in the value-added tax. But the value-added tax's rates went higher and higher and higher. There are now countries, I think, in Europe where the value-added tax is 20%, and the base got broader and broader. And that's the problem with enacting anything that looks like that. Okay, last slide for Biden, and then we'll move on, or 2 more slides. Let's go to the next one. This advertising expenses one, you might say, well, what do I care about that? It says it's only going to eliminate deduction for pharmaceutical companies. It has the same potential creep effect, and that's not the committee to reelect the president, which was Richard Nixon. Rather, it's the fact that if you deny deductions for advertising expenses. Why don't you deny it for the oil companies and just pick whoever you don't like that particular year? So it's kind of a big deal, even though it looks innocuous. All right, let's go to the next slide. And that's the provision that deals with depreciation. And this is not in play in the Biden plan. However, the more people look at Trump's personal tax situation, they're going to realize that part of the reason he didn't pay much in the way of individual income tax is because of depreciation on real estate. So I could predict that's going to get more attention as we go on. Let's go to the next slide. There we are. Deductibility of interest expense is kind of a big deal to business, both unincorporated and corporate. This 2017 Act put limitations on deductibility of interest expense. They are going to get a lot tougher in a couple of years here. And a lot of corporations have loaded up with debt and businesses because of the pandemic. So that's an issue that's clearly a big deal. All right, let's go on to the last slide, and then we're going to go to Trump stuff. Okay, here we are. The last issue is just the income inequality tax, and they don't have one in particular, but as I said, it's clearly going to be a big campaign issue. So it's one of those things that we don't know where it's going. And you might say, well, with all that other stuff you told me about, why are they going to need to do more to wealthy people? And the answer is they have very ambitious spending plans. The Biden tax plan, by most accounts, would increase taxes over 10 years by 3 to 4 trillion. But his spending programs on infrastructure and a variety of other things, the Green New Deal, would increase spending by 5 to 6 trillion. So they may be looking for revenues in a lot of places before it's all over with. Okay, let's go to the next slide, which is what's going to happen in a Trump term. And we'll go to the next slide after that. And as I told you at the outset, we're not going to spend a lot of time talking about this because virtually none of it is going to get enacted as long as Democrats continue to control the House. So I share it with you, and I'm guessing Terry's shared my slides, and you might want to take a look at this stuff at some point. But for example, the third item down, maximum capital gains rate would be reduced. There's been a lot of discussion over the last 2 years that Larry and Steve Moore, who's an economist that advises Trump, have encouraged him to index the basis of assets for determining how much capital gain income you have. So it would raise the basis of the assets each year by the amount of inflation. So you'd end up paying tax on a smaller portion of capital gain. I've talked to senior people at the Treasury Department as recently as a month and a half ago. They took a very strong look at this last fall and met with the Justice Department and concluded they don't have the authority to do that with an executive order, to which one might ask, why would that stop them? Which would be a reasonable question. But it's not going to happen before the election. But if Trump's reelected, I wouldn't be shocked to see it happen next year. Okay, let's go to the next slide. Okay, the top item. There's been a lot of discussion about Trump cut the payroll taxes. And you know, he signed an executive order on August 8th at his golf club. This was a first. The audience for the signing of an important set of executive orders was a bunch of guys in golf clothes who were clearly into their second cocktail. Got to hand it for Trump. He does operate outside the box, and they were respectful if they did hoot a little bit. But one of the things he signed was the provision that said employers could choose to stop withholding the employee portion of payroll taxes, which is 6.2%, through the end of the year. And maybe we'll forgive it, but if we don't, you might have to pay it back. Well, not surprisingly, virtually all employers have said, you know what, I'm going to take a pass on that. Because think of the complexity of this. I decide not to withhold from my employee. The employee leaves at the end of December. I don't even know where he or she went, but I now owe the tax. I mean, so that's a problem. Let's assume the employee stays. I got to tell the employee, we're going to double the withholding from your income for payroll taxes for the next 4 months to catch up with the taxes we didn't collect last year. I mean, this was just a nightmare idea. And the notion that we are going to cut payroll taxes in any way when the Social Security system is about to hit the wall that I described earlier, just not happening. Okay, let's go to the next slide. Okay, so Trump will clearly, most of the 2017 Act provisions expired at the end of 2025. Trump will clearly propose extending them, but Congress is pretty reliable that they don't address things that are expiring until they're about to run out of time, which means it's unlikely Congress, no matter who controls it, will get down to doing anything serious about extending those 2017 Act provisions, the TCJA, probably until we get into 2025, which will be the first year of the next president, which means that in the 2024 election, a key difference probably between the Republican candidate and the Democrat candidate will be where they stand on extending those provisions, because it will then be within the line of sight that they're going to expire. But for purposes of the second Trump term, if there is one, I just don't see how to go. All right, let's move on to tax risks for the life insurance in 2021. And I'll just kind of quickly run through these because I do want to get through the rest and leave time. But I've actually included some details. So let's go to the next slide. First, it is clear that non-qualified deferred comp is going to be under attack. We know that because the Republican staffs, tax writing staffs, pushed to include it in the 2017 Act. Thanks to a lot of great work done by AALU, now FinSecca, that was headed off. But we know how they feel about this. And I was in many, many meetings in 2017, and it was appalling how people did not understand what non-qualified deferred comp is. And I would say to them, do you understand elective non-qualified deferred comp is your employer comes to you and says, next year you're going to make $300,000. You're going to earn $300,000, which I will pay you. However, if you want to decide before the end of this year, not receive $25,000 of that, then we will set up an account and we will pay that to you in a later year, perhaps when you separate from service or you retire. But it's your decision. And by the way, I'm going to have to wait to take the deduction as your employer until it's includable in your income. It won't be includable in your income until I pay it to you. And just so you understand, you'll be a general creditor if I happen to go bankruptcy, but it's your decision. And people on the Hill think non-qualified deferred comp is some like special additional tax benefit that people, they don't even understand. It's an employee's own money. And actually, we were at a critical point in this, and I went in to meet with a now FinSecca member and Chairman Brady, who was Chairman of Ways and Means, a Republican, 8 a.m. in the morning. I explained all this to him, and he looked up at me and looked over at his staff and said, I swear to God, nobody told me that. And it came out. But trust me when I tell you, there are plenty of people that still want to put it back in, which would be basically to eliminate non-qualified deferred comp. Okay, bank-owned and corporate-owned life insurance, they've been under attack in the past. We can expect to see that happen again if there's a major tax bill the next year, whether Democrats or Republicans, because Republicans were proposing going after this in the past. Okay, next item. I've been warning about this one for years, whether there's going to be a cap on the death benefit exclusion or caps on inside buildup. Clearly, we dodged a bullet in the 7 last years of the Obama administration that proposal to limit the benefit of contributions, say, to a 401k plan, didn't get extended to inside buildup, which, by the way, was remarkable when you think about the fact that a 401k plan is a qualified defined contribution plan. Has all kinds of ERISA rules that apply to it, et cetera, caps on how much you can put in. Whereas the amount of life insurance you can buy has almost none of those limits. The fact that they did not extend this to non-qualified savings incentives in the code was remarkable. But I predict it's not something we should assume is going to last forever. Okay, next item, income tax rates go up on the individual side. We'll go to the next slide, but if rates go up, it makes the value of inside buildup greater, assuming you still have it. Estate and gift tax issues. If rates go up, it makes the issue of purchasing life insurance to cover your estate tax liability more attractive, assuming you can afford it. If corporate income tax rates go up, the cost of doing non-qualified deferred comp plans goes up. This is an interaction a lot of people don't appreciate, because remember, the employer has to wait to take the deduction until the employee includes it in the income. When the top corporate rate was 35%, if an employee deferred $100,000 of income, that cost the corporation $35,000 until the deferred comp was taken into income. When you reduce the corporate rate to 21%, it makes it cheaper for corporations to do non-qualified deferred comp plans. So raising the corporate rate back up will make the cost of non-qualified deferred comp plans more expensive than they are today, and therefore less attractive. Okay, last item, life insurance companies. You might say, how could it get any worse for life insurance companies? They had massive tax hits in the 2017 Act. The answer is easy, because there were a lot of proposals that were in play in the 2017 Act that did not get enacted, specifically proposals that would have significantly limited the amount of tax reserves that life insurance companies would have been able to set aside for their liabilities, both annuity liabilities and life insurance liabilities. So the notion that they should have nothing to worry about, I would say, don't take that to the bank. All right, let's just go to slide 28, because I just want to highlight this again, which is the 199 cap A deduction. I already shared with you in the look at the Biden plan that they would propose repealing it. The reason I included here is many independent life insurance agents qualify for the 199 cap A deduction. The regs that were issued by the Treasury Department interpreting this provision could not have turned out better for the life insurance industry than they did. So while there are 19 million businesses claiming this for life insurance, it's a very big deal. Okay, we're gonna go back to the code blue warnings. Again, this could cause nausea, shortness of breath, and hysterical shrieking, as I pointed out earlier. So what we're going to look at is what would be the top marginal rate under current law versus the Biden plan. So let's look at the next slide. This is what we would be looking at if we don't take into account state income tax. So the current top rate on individuals is 40.8. Many people erroneously think it's less, but they don't take into account the 3.8% Medicare tax, which basically applies to all income. Under the Biden proposal, that the individual income tax rate would go up, the 3.8% rate would stay where it is, and on income over 400,000, he would impose the full Social Security tax, which is 6.2, 6.2, 12.4. Every economist that I know believes that both the employer and the employee share of Social Security tax is borne by the employee. That's conventional economic labor analysis. So the Biden proposal would take the top marginal rate on an individual from current law 40.8 to 55.8, a 38.4% 4.46% increase. Okay, let's go to the next slide, which will take into account the average state income tax, which is, if you look right there in the second bullet, the average state income tax across the entire country is 6.31. So under current law, that means the top marginal rate is 47.11. Under Biden, it would go to 62.11. That's a 31.84% increase. All right. For those of you that live in California, when you see the next slide, trust me, I tell you, you're going to pack your bags, you're going to sell everything you got, and you'll be on your way to Nevada, because California has the highest state income tax rate at 13.3. Don't ask me why it's 0.3. Under current law, that means the top marginal rate is 54.1. Under the Biden proposal, it would go to 69.1, an increase of 27.73. So in other words, the top individual rate would be pretty close to 70%. So the fact that the state is completely burning up isn't bad enough. So is any money that you might have had. And I actually did a Zoom call with Devin Nunes, who's from Bakersfield, yesterday too. And he had just flown back from California. And his description of what it's like out there was, his words were horrific, and it's going to get worse. It is truly really, really sad. And particularly sad for Terry and I is the fact that some of the vineyards have been burned. I mean, we're talking serious crisis now. Okay. All right. So let's go to the next portion. And it's accomplishments of first-term presidents in the first year. And the reason we're going to look at this when we go to the next slide is this will give us some insight into when a big Biden tax plan might be enacted. These are the last 5 first-term presidents. Ronald Reagan. I do not include George Herbert Walker Bush, because I really think he was a third Reagan term. Bill Clinton, George W., Barack Obama, and Donald Trump. All right, so let's look for a pattern here. Reagan got elected. He wanted to have a big tax cut. The Economic Recovery Tax Act of 81, signed August 13, 1981. Here's a little snippet of history. Hours before I was on the Ways and Means staff then, hours before we were taking Reagan's bill to the House floor for a vote, somebody realized, oh my God, the name of it is the Economic Recovery Act. And Reagan, therefore, will be signing the ERA, which was like horrifying to him. And we quickly changed the name to the Economic Recovery Tax Act. All right. I don't know if you care about that. Okay. Bill Clinton comes in, has a tax increase, signed into law, August 10, 1993. The Clinton bill is probably the clearest insight into what a Biden tax increase bill might look like and when it might be enacted. And by the way, Bill Clinton's bill was retroactive to January 1, 1993. George W. comes along. His Economic Growth and Tax Relief Reconciliation Act was signed into law June 7, 2001. And you might say, well, why so early? And there's an explanation. Jim Jeffords, who was a senator from Vermont, who was a Republican, had announced he was going to switch parties, which was going to change control of the Senate from Republicans to Democrats. But he said, I'm not going to do it until George W. Bush's tax bill is passed. As a result, Senate Democrats had a huge incentive to just get out of the way and say, let her rip, because as soon as that bill was signed into law, they took control of the Senate, which is what happened. All right. Barack Obama, American Recovery and Reinvestment Act, signed February 17, 2009. Now, to me, this is instructive because it could easily tell us what might happen in the first 2 years of a Biden term, or first 2 months, which is even if we get another economic stimulus bill before the election, which I've said is unlikely, or in lame duck, which I've said is possible, I believe Biden will have a lot of pressure on him to do more. And he can do it in those first 2 months. And he'll probably be able to do it rapidly because the Senate, if it's gone Democrat, will eliminate the filibuster. So they'll only need 51 votes to pass it. And so out of the box, I think because of our economic circumstance, we would see an Obama-like timing. But I believe it would be followed by the big Biden tax bill. And as you can see, my view based on these numbers is that gets enacted by August of 2021. Donald Trump's tax cut is a little of an anomaly. Didn't get enacted till December 22nd of 2017. Frankly, he was running out of time. And if it had carried into 2018, I believe the bill would have died. So Trump was skating close to the edge and getting it done. All right, let's go to the Electoral College. And I'm not going to do into too much gory detail because I want to cover the wild cards. But if we just flash forward, okay, go to the next page. Yeah, go to the next page, please. This kind of gives us the next page. Okay, we could go to the next page. All right, we're not going to the next page, but I'll tell you what's the, all right, here we are. This is kind of the timetable of what's ahead. November 3rd, we vote. And many people don't think we're going to know who won. Disputes have to be resolved by December 8th. Then we go to the next page. The electors are supposed to meet December 14th. The deadline for the Senate to receive the ballots is December 23rd. They're counted on January 6th, and inauguration is January 20. Now, what happens if no candidate has 270 electoral ballots? No one gets elected by the Electoral College. Go to the next page. That's when the 12th Amendment kicks in. And what it does is kicks the election of the president to the House of Representatives, where each state gets one vote based on whether a majority of the House delegation is Democrat or Republican. Currently, Republicans make up the majority of the House delegation at 26 states, and Democrats have 22. You might say, oh, come on, this isn't going to happen. Well, interestingly, to show how our founding fathers were some pretty smart dudes, I don't think they were called dudes, but like if Reagan or Hillary Clinton had been elected, Bill Clinton was going to be first dude. But they were smart fellows, let's say that. And they wrote the 12th Amendment into the Constitution to address this situation. And lo and behold, the 1801 election actually had to be resolved through the 12th Amendment because no one of the two candidates got a majority of the electoral votes. It happened again in 1825. Has not happened since, but there's been more discussion of it this year than I've heard in decades. So I'm not saying this is happening, but you might want to brush up on this so you can appear smart at cocktail parties when we get into December, because that's when people will all be talking about this and everybody will be smart about it. Okay, let's go to the final, last two topics. This is very depressing, so I'll speed through this, but you might have noticed, go to the next slide, you might have noticed that we've run up a significant deficit this year. In fact, our deficit this year is over $3 trillion. That is for the fiscal year that ended yesterday. Over $3 trillion. Let me put that in perspective. We've only been over $1 trillion 4 times in the history of the country, which was 2009, 10, and 11. So we blew through the highest recorded deficits by a mile. But what this shows is where we're headed in terms of debt as a percent of GDP. And what you see here is we have almost reached the point where we are at the same level as compared to World War II. World War II, when we had to launch into a massive effort to win the war. but this is the CBO's projection from September of this year of where we're headed. And that is that debt as a percent of GDP is headed to skyrocketing levels. And by the way, that's notwithstanding the fact that we have relatively low interest rates. So this is scary stuff. And in the next slide, we'll just give you a little bit more of a picture of it, but it will also highlight a really important part. The blue part in there is net interest expense that's projected from this year, 2020, out through 2050. As you can see, our interest expense becomes a number that is larger than the rest of the deficit. That's what you can see, because the top, the purple, is the primary deficit, and net interest is interest on the debt. These are horrifying numbers, and they're probably unsustainable. But when we'll be able to get around to actually doing something about this is anybody's guess. So just some happy thoughts there for you to take back to your office or wherever you go after this is over. Okay, last page. And this is going to be a rapid, very last page, a rapid discussion because, nope, not that rapid. Okay, there we go. All right, so what are the wild cards that could impact the outcome of the election? Well, the RBG effect, Ruth Bader Ginsburg. That was our first October surprise, and it happened in September. September jobs numbers, I talked about those at the outset when I was asked about the stimulus. Outcome of the presidential debates, well, we've already talked about that enough, but we're going to hear more about that than we're ever going to want to forever. The next item I talked about when we talked about, whether there's going to be a stimulus, which is the fact that the third quarter GDP growth number is going to just be a mind blower. And again, you can't rely on investment advice. Even though we all know this is coming, it always shocks me how Wall Street responds to news that everybody could have predicted 2 weeks earlier. It's like, are these guys that dumb? And the answer is, well, they used to be, because when they quit at 4 o'clock, they all went drinking until they were in a stupor, stumbled home, didn't read the newspaper, and came back the next morning and did it again. Now there's no bars open in New York, so I don't know what they do. But my point is, when these GDP growth numbers come out, it's going to be, I predict it's going to be banner headlines in the New York. No, New York Times won't say. The New York Times headline will be Trump had a decent third quarter, but the Wall Street Journal will be record GDP growth rates, and the Washington Post will be somewhere in between. And the New York Post will be Trump kills it. Okay, so I predict you're going to see a big market uptake, and unless they come in weak, in which case the market will go like the other direction. Trump's tax returns, we already talked about that. The wild card is if we don't get another COVID relief bill, does that hurt? Who does it hurt? Does it hurt Nancy Pelosi because she's got a bunch of moderates or worried they're going to lose their election? That's one of the reasons she's trying to figure out how to get a deal, but she also doesn't want to completely alienate her far left wing, which is most of her wing. And in the case of McConnell, he's got 6 senators who are in really tough Senate races. Cory Gardner in Colorado, Steve Daines in Montana, Tom Tillis in North Carolina, Susan Collins up in Maine, maybe Joni Ernst in Iowa. And I mean, that this is a tough issue for them. But as I said when Terry asked me about it, I just don't see where the middle is between the two sides. So that's it. Terry, I'd be happy to take questions from you or anybody in the audience. I know we were on an hour and there's about 2 minutes left.
Well, Ken, I think you've just done a brilliant job. Halloween doesn't look quite as scary as your presentation, I must say. And
interesting thing about Halloween, the internet is loaded with stuff, but one of them is people building contraptions to let the candy flow from the second story of the house out to the street so the kid can still get the candy without, while safe social distancing. Okay. The ingenuity of the American people is unlimited. All right.
You just took the words out of my mouth, and somehow we'll find our way, as we always do. And so we get to do this again on November the 18th, I believe, is the date at noon, Ken. And I really think we should probably wrap it up today, and let's see if we can find a little optimism on November the 18th. We'll see. I don't know, but it's been extraordinary today. Really appreciate it.
All right. Well, thanks, Terry. Thanks for having me, and good weekend, everybody. Ohio State won't be on yet, but we'll be back soon.
Go Bucks.
Yeah, absolutely. I went to law school there, so I care. All right. Thanks, Terry.
Take care. Bye-bye.
Yep.